All right, good morning. Today is February 12th, 2025, and this morning the inflation numbers came out and they were hotter than expected. And I'm sure most of you know that because if you were watching the pre-market right at 8:30 Eastern time when those numbers came out, man, the S&P futures, well, the market futures took a nosedive. And it was pretty interesting because the inflation numbers were, according to some, actually according to what I've read this morning, they were way hotter than expected, and the biggest sort of jump, I guess, in year-over-year inflation in quite a while. And so, anyway, that's kind of put it's put a little damper on the market this morning. Excuse me, choking on my coffee here. So let's dive right in here. I want to start with the weekly chart of the S&P, just so we can put things in perspective, right? So far this week, we're just kind of right in the middle of this recent range here, and I purposely haven't extended this line yet. This particular, these are like the super long-term trends, right? I mean, this is going back to 2021, but what I wanted to do as I was going through my charts this morning, what I wanted to do was I wanted to extend this line up, and I have a few different lines in different places, but in theory, it's tempting to want to connect these two lows. Like on the daily charts, I have these two lows connected, but it is what it is. I wanted to look at this longer term sort of perspective here to start off with, just because everyone's freaking out this morning about the inflation numbers. And so I was looking at the weekly chart here, and what I wanted to kind of see where we are as far as the weekly goes. So anyways, let me save that and go to the daily chart real quick here. Take a look at this. So interestingly enough, this box that I drew, yeah, some weeks ago, several weeks ago or whatever, you can see you can see today's uh, candle here. The low right smack on the 50-day moving average. What's interesting about the past couple of weeks or the past few weeks is the symmetry between like this sort of, gap down and then rally and then gap down and then rally, and we find ourselves right smack in the middle of this range that's been going on since, oh geez, I mean, we're close to where we were, a few days into the new year, right? And of course, the thing to keep an eye on here is today, and we'll have to see how today turns out, but so far today, this MACD looks like it's starting to roll over here, right? I think that last time I was doing a show, I noted a couple of divergences on the MACD here. Basically, the market made a higher high right here, just barely, but the MACD was lower than it was back here. So that's a little divergence to keep an eye on. It's amazing to me how much of a bid seems to be under the market. Like each time we get some news that causes, this was two consecutive Mondays, right? And so two consecutive Mondays we had significant gaps down on tariff talks theoretically. And then Friday we've had some big down days here, right? The market, like, it takes like 3 steps forward and 2 steps back type of thing. It's tempting to draw a trend line across these highs too. And the question is, I suppose I suppose if I draw it sort of across these bodies, well, that's the thing about candlesticks. There we go. in theory, this is kind of parallel to this channel that the market broke out of, and so it's kind of interesting to draw a parallel line there. Sort of about as close enough as you need for a parallel line. Anyway, I'm going to leave that on there. I hate to put too much stuff on my chart because it's just kind of distracting, but to me, the market is sort of range bound. It's range bound between the all-time highs, obviously, and these lows down here around 59 something. Just under, or I'm sorry, 5,900, just under 6,000. And so there's the 50-day moving average. The thing about this chart is that the further you zoom out, the scarier it looks. If you be honest with you, and that's why when I go to this weekly chart here, kind of makes me nervous a little bit, just because of the persistent rally that we've seen since the end of, well, basically since the beginning of 2023. I mean, but the thing of it is, this sort of, let me zoom this chart out even further. I love looking at weekly charts. I really do. That really gives you sort of the big picture here. So I'm going to take this all the way back to, there's the pandemic sell-off. As you recall, market sold off like 35% in a matter of, weeks, literally. And it just looks like a blip on the chart right now. But then, of course, we had that rally. And the current rally is very reminiscent of this. It really is. When I look at this chart, I see symmetry between this and in this current rally. And the sort of spooky thing is that this trend line, no matter how I draw it, if I draw it between these two lows or the way I have it drawn now, but this trend line is itching to get violated, I should say, simply by virtue of the fact, if the market were to trade sideways for another month or so, there is another month and a half, if the market just trades sideways, if it doesn't continue to climb, it's going to break this trend line. So that's kind of weird. I could have sworn that I had, maybe I didn't, but you could almost, there it is. It's probably a different chart that I have. Probably a different chart. I have something like this drawn on it. And so, oh geez. Anyway, this is kind of what we're looking at now. And the fact of the matter is that the angle on this current rally is a little bit steeper than this. But I mean, who knows? I mean, we could be right here. We could be anywhere along here. You'll notice that this rally has a longer duration than this one. I'm not going to bother to count it up, but anyway, I suppose today's inflation numbers kind of throw a yellow flag, or they're like a yellow caution flag, right? And so the CPI inflation jumped 0.5%, which is the biggest increase since summer of 2023, and the core CPI was expected to fall, but it rose instead. So core CPI was 3.3%, and of course we all know that the Fed's target is 2%, which, by the way, we haven't had a 2% inflation print since I mean, in years, since they created, and let me reiterate this, the inflation problem was basically caused by the same effect of why the market rallied back here, is that the Fed created trillions of dollars. Some say $7 trillion, whatever, but to offset the pandemic, right? I mean, it doesn't look like much. That's a 35% sell-off, and so the Fed just basically went crazy with the stimulus, and I've mentioned this before. Some say that somewhere around 40% of all the money, of all the US dollars that exist now, were created, you know, between 2021 and 2023 or whatever. I mean, during this period that we're looking at on the chart. So, us old school people know that the very definition of inflation is an increase in the money supply. And so it's no mystery to anybody that took economics in high school or college. I mean, economics 101. And so the Fed knew exactly what they were doing, but at the time they didn't care because they acted like it was the end of the world. And it's funny thing is, like maybe a year ago or something, I read that the someone at the Fed actually commented to something to the effect of they might have overreacted. All right. And so anyway, long story short, the reason that the general price level of everything that we purchase nowadays is, roughly 25-30% or more higher than it was pre-pandemic is because the Fed's reaction to this, this collapse. I suppose you could call this a collapse. I mean, is 35% a collapse? I don't know. And I'm not sure whether they were reacting to the stock market or the fact that basically society kind of shut down during the pandemic. But anyway, their reaction, it's funny. I read something the other day. The Fed only has sort of two tools at its disposal, despite what they say. The two tools are they can lower interest rates to zero and they can create a bunch of money out of thin air and throw it at the banks and the market and all that. So anyway, I mean, that's it. So what else can they do? The economy itself, it's hard to really know. It's honestly, the economic numbers come out, and you saw, I think Powell was testifying yesterday, and he said the economy's in a good place, this and that, but there's a lot of behind the scenes shakeups going on in the government, and in theory, the new administration is going to be getting rid of tons of government employees, and so what's that going to do to the inflation or to the employment numbers, right? Anyway, the Fed's between a rock and a hard place because chances are the economy itself is likely to slow down at the same time that inflation is definitely not under control. Back to this daily chart here. Um, I'm tempted to extend this box over to the right here. It's going to be interesting to see if we get, a similar sort of pullback down here. The over under obviously is 6,000 on the S&P. I mean, that's a big round number, and it just so happens that's right smack where the 50-day moving average is. And I mean, there's tons of cross currents in the market too, right? I've mentioned before that I mean, all around the world we have the strongest currency, right? The U.S. dollar is the cleanest shirt in the dirty laundry, I suppose you could say. But I think, and I've suspected this for a long time, and I've even mentioned it here, but I suspect that a lot of the strength in our market comes from overseas money buying into, our the Magnificent Seven and the best market in the world, and maybe even indexing. So, um, based on the strength of the dollar compared to other currencies, everybody in the world wants to own U.S. stocks, and that's where a lot of this bid's coming from. Plus, you got the throw in the AI bubble, as some call it, and it's an interesting. There's, I mean, you could list a dozen things, the bullish case and the bearish case, and for many months now I've been talking about how the market is, by any traditional metric that by any traditional metric, the market itself is extremely highly valued based on, price to sales, all that good stuff. PE, price to sales, growth rates, all that. And you see a lot of crazy stuff as far as valuations go. I mean, the valuations are excessive. However, on sort of a day-to-day basis, there just always seems to be a bid under this thing, and so it's like, I get the feeling there's a day of reckoning coming at some point, but until that happens, hey, there's no telling. Um, there's there's certainly a wall of worry, I should say, right now, because you would think with the market, within spitting distance of the all-time highs in the history of the world, and having held this. But then again, if you look at where we are now, I mean, look at today's low. I was talking about that 6,000, and look at where we were, last November, right around 6,000 there. And so market's kind of been, it's kind of been, this is like treading water here. And of course, there was all this craziness around the end of the year here. Um, as you recall, or as I recall, this was the Fed, this the biggest red candle on this entire chart, which is saying something. I mean, this goes back quite a ways. The biggest red candle on this chart is the Fed basically saying that they weren't going to continue lowering interest rates. And so today basically shot a hole in the idea that the Fed is going to lower rates anytime soon. I think now that there's only one cut per, the market's only pricing in one cut for the rest of the year. So month over month CPI was, let's see, what was it? It was double. It was double what it was in December. That's concerning. So, oh yeah, the other thing. This is what I wanted to mention. I was looking at my notes here. Yeah, the 10-year Treasury yield. Look at the reaction. I should change this to a candlestick. Look at the reaction today. And so, if you didn't know what this was, see, this is the other sort of crazy thing. Let me extend this trend line real quick. This is kind of important. Oh, hang on a sec. There, hang on a sec. Close this, save this. Right, phone was ringing. Actually, let me move this out of the way, because what I wanted to do was getting discombobulated here. Anyway, I wanted to zoom in on this. And I mean, this is a pretty bullish pattern right here, right? Like if you were looking at this chart and you didn't know what it was, say this was a stock, this breakout today, I mean, you got this rally and this real sort of symmetrical pullback in this break here. And so basically, this is what everyone's watching here, is this 10-year Treasury yield. And in theory, this is inverse to the market. I'm going to say, somewhere around here, around this high right here, is where everyone starts to get nervous. And so the fact that this is kind of breaking out here is a little bit concerning. All right, let me close that, save that, and there we go. So keep an eye on that. This is probably, the number one thing that everyone's watching as far as like, inverse to the actual market. Let's look at the Qs real quick. Let me go back to my daily chart here with the candlesticks, because let's see how the Nasdaq's doing here. Nasdaq's got kind of a weird little pattern going here. You can draw a trend line across these highs, and that fits pretty good. That fits really good. And then of course, it's debatable how you want to draw this downtrend line, but it's been I mean, it's been holding on really well, right? There's no question that the Nasdaq has been extremely strong. But there's a couple ways to look at it. It has been sort of treading water. When I zoom out on a lot of these charts, it looks to me like there's a big move coming in one direction or the other. Oh wow, Powell's testifying again today before the House Financial Services Committee. So this is always kind of interesting. And what's going to be really interesting today is to listen to what he says in the context of these hot inflation numbers. So um, after today's inflation report, the markets only sees one rate cut this year, way out in October. And then so there's no other rate cuts priced in. So higher for longer is the narrative after today. And the funny thing is that the Fed let the inflation cat out of the bag a long, long time ago, and so they've been tooting their horn. It peaked at like 9.1% or something like that. A couple years ago in July in the summertime. And so, anyways, inflation, obviously it can't stay at 9%. I mean, that's just crazy. That's why everything's so expensive. But so, peaks, they let the cat out of the bag. Inflation gets up to 9% and then spends the next, couple of years slowly drifting down and drifting down and drifting down. And they're taking credit for the idea that the rate of inflation has been declining, and obviously it's down to it's not anywhere near their 2% goal. And so what people are starting to realize, and of course I've been talking about this for years, is that inflation compounds, and so the damage is already done. I mean, literally, the damage is already done. Everything is inflated. The price of, asset prices are inflated, home prices are inflated, taxes, real estate taxes, insurance, I mean, everything got inflated. And so like I said earlier, the general price level is, 25, 30, maybe even more. It's hard to generalize about that. Some things are 50% higher than they used to be, and it's not going back down. And that's the whole thing about it. And so if you take something and you make it way more expensive and then add another 3% to that, um, that's bad. And so people are starting to realize the whole thing, and the media loves to, use wordplay and pretend that the rate of inflation coming down means that prices are coming down, and that's just not the case. And so they try and convince the public, and I think the public now is starting to become aware of the idea that, and of course this is, something they've talked about more, is it's not the rate of inflation that matters, it's the general price level. And so they really screwed up. And then of course, the latest thing is all the government waste that is theoretically being cut. And so I don't know. To me, it's a recipe for, there's a lot of potential for something to go wrong. It makes me nervous because with the market being so valued, and of course you see all these crazy metrics. I mean, everything is all about the Magnificent Seven, right? I mean, you can take it's like it's like out of the S&P 500, or even the Nasdaq Composite, right? I mean, there's maybe say 10, 15 stocks that represents the entire market is basically what I'm trying to say. So the one last chart we'll look at real quick here, Russell 2000. Russell 2000 has pretty much sold off fairly significantly. Let's go back and look at the weekly chart. Here's the thing. This is part of me wants to say that this is extremely bullish looking because it's a big, giant, multi-year cup with, a potential handle forming. And so, but then again, it's hard to, it's hard for me with the rest of the market at all-time highs and so richly valued. It's hard for me to imagine that, money's going to start pouring into the small caps. But I got to tell you, this is a very bullish looking chart from a super low. I mean, you got to go back to 2020. The Russell 2000, which used to be my proxy for, the overall market, is essentially in the same spot it was back in, 2021 or the end of 2020. I mean, it's just amazing. If I put a horizontal line on this chart, and maybe I should have drawn a horizontal line, I mean, this is just absolutely incredible. So think about the idea. Let me see if I can get that straight. That looks pretty, it's close enough for government work, as they say. And so if you look at that, this was, this was the beginning of 2020. So you got 3 years. I mean, 3 years of basically zero return on the Russell 2000. And of course, I mean, here's the pandemic right there. There's the pandemic sell-off and then the subsequent rally. And this subsequent rally is just, to me, is just based on the fact that it's repriced. It repriced based on the fact that they created all the trillions of dollars out of thin air, right? Things like the reprice to adjust. And so asset prices adjusted for the amount of money in circulation, the amount of money, total M2, I guess you'd call it, or whatever. But anyway, this is an interesting chart because if you think about it, 3 years, 2,000 stocks, the smaller 2,000 stocks in the country, have gone nowhere for 3 years. So be a good and plus spent the majority of the past 3 years like underneath this high. This is sort of the high water mark. This was about you talk about a false breakout. That was just about the craziest false breakout ever. Because I mean, look at the time period here. I mean, you're talking 8-9 months of sideways consolidation, and then finally get a breakout and just this is a weekly chart, obviously. We're just rejected and a pretty significant sell-off. And so, hey, you got a little bit higher high here, but it's a little disconcerting. Anyway, crazy stuff. And so Powell's on speaking now, so I'm going to wrap this up and listen to what he says. But basically, for the SPX, I mean, just keep your eye on the bigger picture here. Keep your eye on which way this thing sort of break. I mean, if it doesn't hit a new high, we're right smack in the middle of that box. Let me go back to this daily chart just so we can see where we are in the box. To me, everything is about which way it breaks out of this pattern here. And it very well the bid could continue, right? There's a few reasons. Well, there's quite a few reasons why this market could continue higher, but right now it's just kind of stuck in no man's land. So it's very difficult to know what's going to happen in the medium term. So anyway, thanks for tuning in. I'll see you back here next week.